Welcome to this explainer. Today, we are going to completely unpack BlackRock's massive Q2 2026 performance. We'll be looking at their blockbuster earnings, digging into their massive new AI infrastructure investments, exploring their dominance in digital assets, and, critically, breaking down the evolving risks every investor needs to know about.
All right, let's just start by establishing the jaw-dropping scale of BlackRock right now. $15.34 trillion in assets under management as of June 2026. I mean, to put that into perspective, that is literally larger than the GDP of most countries on Earth. It's not just a record, it's a 22% jump from just a year ago. It absolutely cements their position as the undeniable heavyweight champion of the asset management world. To keep things organized, we'll break this explainer down into four main parts: the behemoth's earnings, financing the AI boom, dominating digital assets, and finally, navigating risks and ESG.
Part 1. The behemoth's earnings, smashing expectations. So they didn't just meet Wall Street's expectations, they absolutely smashed them out of the park. If you look at the numbers, revenue jumped a massive 31% year over year to $7.08 billion. And whether you're looking at standard accounting metrics like GAAP EPS or their adjusted earnings, the metric that strips out one-time cost to give us a clearer picture of the ongoing business, both comfortably beat estimates. And look at that operating margin, expanding to 45.9%, which is the highest it's been in nearly 5 years. So they're getting bigger for sure, but they're also getting remarkably more efficient.
Now, you might be wondering what's actually driving all this incredible earnings momentum. Well, it really comes down to client trust and money in motion. Just during this quarter alone, they attracted $192 billion in net new client money. Zoom out over the last 12 months, and net inflows totaled an astonishing $868 billion. That means they brought in nearly $1 trillion in net new money in a single year. $1 trillion!
And this quote brilliantly illustrates how leadership views the current macroeconomic environment. CEO Larry Fink stated that market fundamentals are strong and well-supported, catalyzed by new technology. So they aren't just coasting on a generic market wave here. They're seeing a very distinct technological catalyst that's driving those higher margins and deepening their global client relationships.
So, how exactly is Wall Street reacting to all these numbers? The consensus is overwhelmingly positive. Out of 17 analysts polled, we're seeing 14 buys, 2 strong buys, and just 2 holds. But the most surprising part? 0 sell ratings. None. And with an average price target of $1,316, analysts are clearly seeing some significant potential upside from current trading levels.
Moving right along to Part 2, financing the AI boom, putting capital to work.
BlackRock's recent strategic moves have perfectly laid the groundwork for what is essentially a massive infrastructure play. First, they went out and acquired global infrastructure partners and HPS investment partners for over $24 billion combined. Then, they immediately put those acquisitions to work by partnering with tech giant Meta. This whole thing culminated in July 2026 with a highly oversubscribed $12.5 billion bond sale. And get this, it attracted $20 billion in orders, even with broader tech debt sell-offs happening at the time.
The sheer physical scale of the project those bonds are funding is pretty staggering. We're talking about an El Paso data center designed to provide 1 gigawatt of computing capacity. To put that into perspective, that is roughly enough energy to power a mid-sized city, all built purely for AI workloads. And BlackRock subsidiaries hold an 80% stake in this project, while Meta holds the remaining 20%. This just proves BlackRock isn't just managing equities in the AI space, they are literally financing and owning the physical data centers that are powering the future.
All right, Part 3, dominating digital assets, the crypto frontier. By August 2026, right as Bitcoin was approaching the $70,000 mark, U.S. spot Bitcoin ETFs, the funds that let everyday investors track the crypto's price without holding the coins directly, were pulling in some seriously huge money. But BlackRock's iShares Bitcoin Trust, or IBIT, was just the undisputed leader. On one single day in August, IBIT pulled in $143.6 million. That means they captured nearly 76% of all daily Bitcoin ETF flows across the entire market.
Now, the crucial point here is understanding why they're pushing so hard into crypto. It's really not just about a Bitcoin ETF. Management's broader vision, driven again by Larry Fink, sees tokenization as the next generation of markets. BlackRock is actively exploring tokenized ETFs, treasury funds, and private market products. Their ultimate goal? To reach an estimated 5 billion digital wallets worldwide. It's a massive ambition.
Which brings us to our final section, Part 4, Navigating Risks and ESG, the bear counterweight.
First up, let's take a look at their environmental, social, and governance strategy. BlackRock is notably softening its ESG criteria to align with what they're calling evolving market expectations. Basically, they've halved the required ESG score uplift on certain funds, lowered carbon reduction targets from 30% down to 20%, and they officially withdrew from Climate Action 100+. Now, regardless of where you personally stand on ESG, this represents a significant strategic business pivot for the firm, and it's something investors absolutely have to factor in.
Beyond those policy pivots, there are some very objective financial risk factors we need to monitor. First off, their price-to-earnings ratio is sitting at 27.7. That's historically elevated for them, which basically means investors are paying a premium right now and expecting absolutely flawless future growth. Second, remember those massive acquisitions we talked about earlier? Well, they drove total expenses up 25% year over year. Third, despite the massive overall inflows they saw, they actually had $41 billion flow out of their low-fee index products. And finally, their newly acquired HPS fund saw 13.3% in redemption requests. So these are real, tangible pressures on the business.
Yet even with those real risks we just covered, there's a really fascinating disconnect between the current price and the street's expectations. As of mid-August 2026, the stock was trading right around $1,158. Compare that to the average analyst target of $1,316. That means the stock is currently trading about 13 to 14% below Wall Street's average price target.
So we've looked at the record $15.34 trillion in AUM, that aggressive expansion into AI infrastructure and tokenization, and we've balanced that against elevated valuations and some pretty significant ESG pivots. So I'll leave you with this final thought to help you formulate your own investment opinion. With all these moving parts, is the world's largest asset manager still a buy for your portfolio? Thank you for joining me for this explainer. Keep questioning the data, and I'll catch you next time.